Teare leads the strategic research at Crunchbase. She covers global fundraising trends, women in tech, and women in venture based off of the Crunchbase dataset. She is an experienced public speaker and moderator connecting with startup communities around the world. Recently, Gené published a report on global VC market trends in 2020 through the pandemic, and she will share her insights with us today. Linus Liang is a partner at Signia Venture Partners. He is a serial entrepreneur with expertise in technology and medical devices. He most recently co-founded a company called Embrace, a social enterprise that develops and distributes a low-cost infant incubator for developing countries. Prior to Embrace, Linus founded several software companies in the mobile and social networking space, the last one resulting in an acquisition by Signia. Stacy Kim is the co-founding partner of Wilson Sonsini London office. She is a leading American cross-border technology lawyer and strategic business advisor. Stacy has a unique experience as a trusted advisor to high-growth US, UK, and other European companies. She has a particular focus on supporting companies with their fundraising, corporate reorganization, and commercial expansion. Stacy advises technology and life sciences company at all stages of the corporate life cycle. And finally, David Chreng is a founding partner of LeadBlock Partners. He has an engineering and fundamental investment background with years spent on biophysics, R&D, industry research, corporate strategy, and financial modeling. Previously, David worked as an equity analyst at Goldman Sachs, covering the energy sector and providing investment insights and ideas to global fund managers. And with that, let me pass it to Gené.
Hi all, let me share my screen. So what I'm going to do today is talk through global funding pandemic in 2020, just through the crisis. And let me just start presenting. There we go. And what we've been doing at Crunchbase is we obviously collect data on startups, the investors, the founders right around the globe. And we have on a monthly basis been tracking funding through the crisis just because of the shifts in the market, changes on a monthly basis. And we want to make sure that we're very close to the ground and understanding what is going on. And thank you to Juan and Stanford Startups for hosting us here today. So quickly, what we're going to do is, as I said, I'm Gené Teare. I'm a data journalist at our Crunchbase news group. You can find me on Twitter at Gené Teare. And I think to kick off, one of the things that I've noticed about every crisis, I've gone through the dot-com crisis. I was at a company at the time that was planning to go public and did not go public. And when we talked to our investment bankers and we said, well, if we're not going public now, when can we? And their response was, never. This is over. The whole market has changed and you're never going public. So what's been interesting for this crisis is I think we look at the last crisis to inform our findings. And in the last crisis, I'm sure many of you who were around were aware that Sequoia, one of the most famous VC firms, and I think they have the biggest returns in the market or very good returns in the market, they wrote a piece called Rest in Peace, Good Times. And basically what they were saying was everything has changed. And the idea that you're going to be able to go and raise a 15 million Series A at 100 million post, those days are over. In fact, the funding market might be over, customers will be impacted and cuts are a must. So it was a very harsh reality at the time, but they were playing off the 2000 crisis when the whole asset class had been wiped away. And I think this time around, Sequoia came out again with a black swan. It wasn't as definitive as the Rest in Peace, Good Times, but certainly everyone today, and I know when I spoke to some of the investors, David and Linus, they said they were very much informed by the 2008 crisis. And in that crisis, it was the financial community. And so a lot of investors feared that their backers or people who had invested in their funds would not be able to follow through and invest in the startups. What we saw at the time, and this is a slide looking at the top 50 investors globally by each sort of asset class. So if you look at venture, it went down by about 30%. 2008, at the end of 2008 was the crisis kind of hit, and 2009, you can see venture pulled back quite massively. As I say, these are the top 50 leading venture firms, pulled back by about 30% when it came to their investing thesis. When you look at micro VC, I think what's interesting for the micro VC, which is a light purple line, is they pulled back, But because it was a new and emerging asset class at the time, you can see they quickly recovered and went on to sort of exceed the pre-2000 or 2008 time period. When you look at the one other asset class which we looked at, which was PE and alternative investors, they were incredibly active pre-crisis, went down, and didn't really cover through this time period in the crisis. So they looked at the market and decided, we're going to go away and we're going to step back for a while. What we see by each funding stage is very similar trends. So you'll see on seed, that continued growing through the crisis, again, because in 2008, it was a very new asset class. If you look at Series A, B, and C, it was down in both 2009, 2010, and 2011 and 12 is when it began to come back. And this is the amounts invested in each of these classes globally. And so it took really 2 to 3 years for the funding market to come back in the last crisis. However, I think what everyone is informed by in the last crisis, and a lot of people speak about, is some very key internet companies were created during that crisis. This because of the newness of mobile at the time, mobile technologies, with the launch of the iPhone, and also with the cloud and the launch of AWS. And these are all companies that were created at the end of 2008 or early 2009 that went on to become incredibly leading companies in the aftermath. And what this showed investors, that even though there's a crisis and even though you might want to pull back, it might make sense to actually lean in and invest through a crisis, because some companies go away, but some companies emerge much stronger. And obviously there were new technologies that were sort of pushing this change. Now what we're going to do is go forward to 2020 to look at the impact in this crisis. And I think for all of us, we're feeling a little bit like these slides. I think here in the US and around the globe, we've been impacted obviously by the pandemic, and it's all a little feral. We're all at home and we're all eating at our desks, and there's no division between work and play. And at the same time, we've had a lot of racial justice issues, especially here in the US, because of the killing of George Floyd. So I think these two tenors have sort of impacted us all this year. And hopefully with the election and with the virus that we're going to talk about the virus a little bit today, but the fact that we might be coming out of this crisis. Quickly, what I want to show you is NFX, which is one of our partners we worked with. They surveyed all of their founders to sort of try and understand sentiment through the crisis. And this was sort of taken in June. It was 2 to 2.5 months into the crisis. And what's interesting is, even though there was an incredible amount of fear around the impact of the pandemic, what we found is that, a third of companies through their survey had their revenues impacted, but a much larger majority, 50%, saw very little change, even though everyone prepared for massive change. And then for a smaller percent, but quite significant, 23% saw growth through the crisis. And again, this was early on. I'm sure these numbers would have shifted since then for probably more companies who saw revenue increase through the crisis. What was also interesting is that every company kind of hit a button to stop. And for most companies, the thing that they slowed down the most on was hiring. I know for us, we started hiring less, significantly less. A lot of companies froze their hiring. And I guess what's interesting here is this is the reverse, where more than 2/3 of companies slowed down their hiring. And I think what this meant for a lot of companies is that they were in a stronger position through this crisis and post the crisis, because for many companies, their balance sheets were stronger. And also they used this time to sort of look at what they should focus on as a company and take out some of the extraneous strategies. This is just a quick slide, which I thought was interesting, giving some of the panelists, which showed, again, in this June timeframe, which industries had grown through the pandemic and benefited, and which had immediately sort of contracted. And I think what's interesting is, travel tourism was massively impacted, but we've seen elements of that come back. And obviously Airbnb is filing to go public. Again, in the recruiting space, that seemed to be massively impacted as the crisis hit. But then, there'd been a lot of recruiting startups who've benefited and actually grown. And I think Handshake, I wrote about recently, just announced a very large round. So even the sectors that were massively impacted, we're beginning to see some of those sectors come back. This is 2019 and 2020, and looking at global funding on a monthly basis to track where we are. And I think what's interesting here is that in 2020, there was definitely a pullback. There was a sense that things were changing. This was even the pandemic really hitting the US, but it started to obviously hit in China and other parts of the world, and the seriousness of it was beginning to come through. Every other month subsequent to that, and this is global funding, was higher, either at or higher than 2019. 2019 in our database is not a height of funding. The peak for us is 2018, was the biggest year in funding. But 2019 was a very strong year in funding and came in just behind 2018. So the fact that 2020 is superseding 2019 at this point, I think is very interesting for all of us. You can see October was above October last year at 22, and the third quarter, which I circled, was quite substantially, especially September was a very strong funding month comparing year over year. We have a unicorn leaderboard, which you can all see at Crunchbase. I just wrote a piece which looked at 14 new unicorns who joined the unicorn in the last month. 14 new unicorns joined the board. So at the moment, there's about 630 companies who valued just below 2 trillion, which is currently the market cap of Apple. And the total they've raised is just north of 450 billion. So what we have seen in our data, and the reason I'm showing you the unicorn leaderboard is late stage has been incredibly strong. We have a board which anyone can go to look on our featured list on Crunchbase. So I think in summary, and we're going to talk about some of these trends with the panelists, is venture has seen huge opportunities, which in this pandemic, which has been very different from 2008. And also since June, it's been a very big year for IPOs, and M&A has also been incredibly strong this year. So a huge year for liquidity in the market as well. Okay, and now I'm going to stop sharing so we can jump into the panel portion of this. So welcome everyone. You've heard a lot from me. And I'd just like to say all of us are spread out across the globe at this point. So Linus, you're from Silicon Valley, as am I. I know a lot of you are signing on from New York. And then also Stacy and David, you're signing in from London, and it's pretty late. So we appreciate you joining us today. So welcome all. So to kick off, I want to start maybe with Linus, with you, just because your fund, I think, has been around the longest. Signia Venture Partners was founded in 2012. As I said, you're based here in Silicon Valley, and you just raised your third fund in 2019, which is an 85 million seed stage or early stage fund. So do you want to tell us just a little bit about how your firm plans to, or has planned to invest that fund, and whether you've been investing through the pandemic?
Yeah. No, thank you. Thank you also, everyone. And I appreciate being here and you guys all taking the time to listen to this panel. So just some background on Signia, just to elaborate a little bit more. As Gené said, we were founded in 2012. We're on our third fund right now, and each fund has been around $85 million. So we're early stage investors, mainly in the technology space. And as you said, we raised our last fund in 2019, right before all the pandemic and all that stuff happened. And so I would say, to answer your question, right when the pandemic hit, much like everyone else, we were frozen in our tracks. We didn't know how to foresee what would come. And so I would say for the first 2 quarters after the pandemic hit, we froze all investment activities. We focused on making sure our companies could survive this, planning out things, the contingency plans. We even shut down one company. So it was pretty crazy when it first happened. But now in the last quarter, I would say things have picked up, as the data has also shown. And we're making new investments. And there are anytime there's a pandemic or anytime there is some disruption in the system, there is also a lot of opportunities. So yes, we're actively investing. We're looking at a lot of new opportunities in terms of the future of work, which is what a lot of people are looking for in transportation. My background is in big data, AI, a lot of new opportunities in that space, and it is picking up. And I would say the one thing that I think was really refreshing and really interesting is that the deals we are looking at now are not just in the Silicon Valley, and that's very different from pre-pandemic, where our base is here, our network is here, and we focus just a lot on deal flow in this area. But now deal flow is coming from all over the country, which I think is actually giving more opportunities to people in even in New York, or even some smaller cities like Austin is another big tech hub, and there's several small tech hubs throughout the United States, like Chicago has a big emerging tech scene too. So it's pretty cool to see entrepreneurs from other places who normally wouldn't get the time or the opportunity to talk to VCs in the Bay Area have that opportunity now. And so I think that's one silver lining in all this craziness that's been going on for the last 8 months.
Sure. And so for the $85 million fund, how many new companies do you seek to invest in? And over
Sure.
sort of what time frame?
Yeah, so the way we're standard VC, so we have about per fund, we have about 20 to 30 companies we invest in. And that is through the investment time is through so each fund is 10 years. We usually invest in the first 6 years, make new investments in the last 4 years is basically managing the companies and helping those companies either grow, exit, and then eventually so we can return capital to our investors. But yeah, it's very standard, typical VC.
Got it. Okay. And are you seeing the people who are reaching out from across the country, are they people who've left Silicon Valley or left the big tech hubs? Or is it more that things have broken down to the point where it doesn't matter where you are anymore because you can get on a Zoom call?
Yeah, it's crazy. So there have, to your first point, and that's a whole, we could talk for hours on all the people who have left the Bay Area and moving to other parts of the country, which I also think is actually a good thing. It's spreading the knowledge, and the Bay Area was just too concentrated with tech geeks here. So I like that, and I like that dispersion. But no, most of the companies that we've seen are just entrepreneurs that are that now just basically have that opportunity to just hop on a Zoom call, like you said. And we've always actually had them. It was just hard because the normal, I guess, mode that we operated in was you have to meet the partners. I have 3 other partners at my firm, and we have to meet. And especially with early stage deals, it's all about the team. Technology and the traction are less important because, I mean, it's so early in the stage of a company that usually isn't proven. So a lot of it is face to face and trying to get a sense and pulse of how a person operates and how the company is operated, et cetera, et cetera. But obviously we can't do that now. So then we're taking more we're taking more meetings with people outside the area, and we have to get, this is a skill we have to get good at, because even when there is a vaccine, it's probably not going to be normal for another 2, 3 years, I mean, I don't even think it will go back to normal. My prediction is we're going to have some new mode of operating, and so this is a skill that we're learning, and we have to do those assessments and those sort of diligence checks without doing these face-to-face meetings, and we'll see how it goes. I think, you know, for more or less we're still experimenting with several things, and I think it's going to be interesting the next couple quarters and see how they play out.
Got it. Okay. And David, I'm going to shift over to you as the other investor on the panel. So you're at LeadBlock Partners, which invests specifically in blockchain. You're a co-founder and a partner, and you just started the firm in 2019, so just pre-pandemic. And from what I understand, you're in the process of raising a fund. Is that correct?
Yes, so we've done an initial closing at the beginning of the year, literally, you know, a couple of weeks before the beginning of the lockdown in Europe, with GP money and our close circle. So we were fortunate enough, you know, to have enough capital to look for deals, but also to inject it. So the first deal we made was actually in a food tech company in end of beginning of March, and that was a tricky decision, of course, because we started to see, you know, the lockdown happening, you know, from Asia moving across Europe and moving towards the US, but we still had, you know, to take a decision, and we decided to invest alongside the bank plans, and that proved to be quite fruitful, because the digital is taking a bigger part of our economy. I think the you know, as Linus was mentioning as well, it's a new way of operating. I pretty much share his view where he's mentioning that I don't think we're going to get back to, you know, to pre-pandemic, because suddenly, you know, corporates, governments, individuals are realizing that some things can actually be done offline from a virtual standpoint. And I also think, you know, from the discussion that we've been having with the fund, with corporates, is that it's been a major catalyst, a major hit, you know, for to realize that digital travel becomes top of mind. It's also a way, you know, to readapt and reshape some of their way of operating adapt to tomorrow's world and to take on board, that opportunity. So that's something that's quite interesting and important as a trend. And they basically, if some corporates were thinking about a digital transformation in the next 2 to 3 years, the pandemic has clearly accelerated their mindset on that front. So I think it's quite different from what we saw back in 2008, which was mostly, liquidity crisis in the financial service sector, and that also led to the fintech ecosystem as such. But as of today, I think the tech scene, technology in general, access to computation firepower is a lot different to what it was 10 years ago. Now, it's a lot more accessible, costs are relatively low, and corporate has also had like over a decade to learn how to work with startups as well. So I think today the ecosystem as such and the environment is a lot more favorable for startup, in tech to actually, collaborate with those corporates, but also take a major part of the, of the groundwork to do in rebuilding and reshaping tomorrow's world.
Okay. And so what I'd love to understand from you, David, is I always find blockchain incredibly difficult to sort of grok and get my head around. So what is it that, why would you choose just to invest in blockchain technologies? And why, what do we all need to understand about blockchain to really understand what the opportunity is here?
Yeah, I mean, the focus of the fund, as you mentioned, is on B2B blockchain solution, and the rationale behind that is quite simple. Is that our investment thesis is around the data economy as such, and the fact is, I mean, there's been more data being produced over the past years than over the combined history of mankind. And number one, this volume of data is not going away. And number two is highly likely to grow over the coming years. So, to us at the fund, blockchain has a fundamental role to play in order to increase value there. And because it has the ability to transform or to refine, raw data into valuable information. And the way see it is like the way we buy and sell goods and services, thanks to the internet layer, like the TCP/IP protocol. But here we see blockchain application as the next leg to transform how industries are going to leverage data overall. So basically what we see, and that has been also catalyzed by the COVID-19 crisis, is all sectors within our economy today are facing rising digitization challenges. And blockchain technology combined with some of the deep techs of the like of artificial intelligence, machine learning, for instance, could be an effective response to some of those challenges, including on industry sovereignty, for instance, supply chain resiliency or transparency. And that's the thing that for all computer, linking different deep techs, you have the ability to understand the industry from the ground, from an operational standpoint, so that you can make the difference by combining the industry expertise with the tech expertise towards improving those challenges in several industries.
Got it. Okay. So we'll come back to you in a little bit about some of the industries that I think are interesting on the blockchain side. I think, Stacy, we'd love to go over to you. So you have worked in the US with a startup tech scene. The London office for Wilson Sonsini Goodrich Rosati was started a couple of years ago, and you went out to head up that office. And your role is really to help companies from the US come to Europe, and also vice versa, but more companies from Europe who are wanting to come to the US, of which I'm sure there is a huge amount. So what is the biggest difference that you've seen between the European tech scene that you've now been embedded in for the last 2 years and what you saw in the US before you went to London?
So thanks for the kind introduction. So for everyone here, my name is Stacy Kim, and I am one of the co-founding partners of Wilson Sonsini London office. And Wilson Sonsini, we were the very first tech and life sciences firm headquartered in the Silicon Valley. And as of today, we help more tech companies with their VC financings, M&A transactions, growth stage financings, and IPOs than any other tech firm in the world. And also I'm a Stanford grad. So born and raised in California, went to New York, helped out tech companies and their investors there for about 7 years. And then about 8 years ago, I moved out to London and have been helping European companies access the US markets. And as exactly as you said, it's really about helping European companies raise monies from US investors and also expand out their operations. And they really go hand in hand. In terms of the UK tech scene, arguably the angel investor market is stronger here in the UK than it is in the US. And the reason for that is twofold. So one, access to talent, which Silicon Valley and New York and Boston and Austin, all the ecosystems in the US have an abundance of. But the government has actually the UK government has actually provided tax benefits to incentivize a lot of high net worth individuals that we have no shortage of in London to invest in UK companies. And that's what we call SEIS, EIS, VCT. And those tax benefits, were passed in the spring of 2012. And so that's when I arrived to the UK. And at that point, it was up in the air whether or not the main tech ecosystem was going to be Berlin or if it was going to be London. And most people thought it was going to be Berlin at that time. But then the tax benefit regulations were passed, and that really jump-started the economy in the UK. So, in terms of the angel investment market here, it really facilitated getting the monies into these UK tech companies and also European companies. And now we're still in the first generation of founders here in the UK, but we've started to see more unicorns and also more of these companies expanding out to the US, raising monies from US investors. In terms of the difference between the two tech scenes, it really is about maturity. And with maturity comes a level of sophistication. So because we are still with our first generation of founders here in the UK and in general in Europe, a lot of founders haven't gone through the life cycle of their tech or life science companies. They're still sort of going through that process. So, in terms of what is considered normal, what is expected, that knowledge necessarily isn't there for the European founders as it is in the US, where since the ecosystem in the US has been around so much longer, everyone involved in the tech scene, the life science scene in the US, they're very sophisticated in terms of, how much equity does a founder get, in the beginning? How much equity should the founding team have at the Series A stage? What are normalized vesting terms, and so forth. So, in terms of the difference between the two ecosystems, I would say it's maturity, and with that comes sophistication. Also, in terms of raising monies, there is just more money in the US. And, when US investors invest, they typically invest in larger ticket sizes because the US investor sort of approach a lot of times is to look at sort of global scale, domination of the US market, but then global, like how do you bring the company to reach a global scale? European investors, also they are thinking globally, but, a lot of times because of a lot of European VCs, they get funding from state governments. They may have actually requirements that they can only invest in companies that keep, their people or their assets, within certain jurisdictions in the EU. And so, for them, they don't necessarily need to see a company that's looking to move out to the US or to China, or Asia or the Middle East right away, because, in order for them to deploy their monies at the early stage, really, it needs to just sort of be focused within the EU.
Got it. And you talked a little bit about the fact that cap tables, typically the biggest thing that you need to fix as a firm is the cap tables for a lot of European startups are in a mess. So what does that mean, and why is it, in such a mess? And you'd think in this internet age, we'd all be educated on how to structure a cap table for a company. So what are the issues you see there? And I'd love to know how much equity should be reserved for this, the team at a company and how that gets handled.
Yes, yes. So at least when you start your company before your first institutional round, if it's before a seed round, or a A round, um, the founding team really should have about 70% of the outstanding equity. And, it's twofold. One, the founders want to be incentivized. And two, for the investors like David and Linus, they want to make sure when they invest in the company, as Linus said, he's really investing not only on the idea and, the potential market size and growth of the business, but it's also the founding team itself. And he wants to, the investors want to make sure that the founding team is properly incentivized to stay with the company and work really hard. The reason that I see a lot of European companies where, they haven't even raised their institutional round yet. They've taken on a lot of angel investment, a lot of convertibles, and it goes two ways because, I mentioned, for example, in the UK, we have a really strong angel financing market, but they're not necessarily professional investors like David and Linus. They're high net worth individuals that made lots of monies, in other industries. And in many ways, with this tax incentive, this is a way for them to diversify their investment portfolio. With a very sort of low risk strategy because of the tax benefits that they get through the government if they invest in these tech companies. So, when you have those investors and you have founders, first generation founders who are negotiating deals, and no one really knows, no one really has a thought about, founders, staying on with the company, being properly incentivized. Because, for just to give you a little bit of background, for the UK tax benefit schemes into these tech companies, actually, if the company fails within 3 years, that's okay for these investors because they get almost like a 90% return back on their investment. Plus, they've gotten all of the deductions on their tax benefits for the years prior. So, they're not really thinking about, exiting from this company or having the company grow and exit and incentivizing the founders like, other European investors or US investors that are not investing on a tax basis. So, when you have first generation founders and, angel investors that are investing on a tax basis rather than a long-term investment viewpoint, you end up with cap tables where, before the Series C round or A round, founders are only holding, the founder group will only hold like maybe 30%, of the company. And so at that point, once you get the institutional investor that comes in that usually wants to get, at least 15% of the company or 20% of the company, then, the founding team doesn't really have much incentive actually to stay on. And that's really difficult for the institutional investors because that's a risk for them. So then, what do? Like all of a sudden you come into this strange world where you're pre-institutional financing, you're a pre-series seed financing company. We're talking about a recap, which the legal lift is very high, for that. Or, more commonly, because the legal lift is so high for a recap, you're actually, working out a way where you gross up the option pool and you just, issue a lot of options to the founders to try to gross them up to a point that's acceptable. And then we create some sort of liquidity scheme to have the angel investors actually be able to exit and get some sort of return so we can reduce the angel shareholdings and increase the founder shareholdings at the same time. So there's other ways to handle it, but that's really what it is. The tax benefits were a great way to jumpstart the tech ecosystem here in the UK, but there is a conflict because obviously you had a flood of investors that, who were not professional investors, and they were investing not on the basis of the founders or the potential growth of the business, but it was more for a diversification of their investment strategy.
And that's interesting. It's interesting. I didn't realize London took off for those reasons, but that's incredibly interesting. I think what I'd like to take it back to, and I would like to open it up to anyone in the audience who'd like to start asking questions. I'm not sure if it'll come through on the chat. One can let us know, but basically we'd love to hear your questions as well, given we have these three experienced individuals on the panel. I guess one of the things that I'm interested in that I think both David and Linus sort of match up on is, Linus, you're investing in data and machine learning and AI companies. And I know, David, we talked and you talked about food tech, blockchain being incredibly important for all, or could add a piece to the puzzle. in terms of all these data-driven companies. So I'd love to hear from you, Linus, just a little bit more as we wait for questions from others on what are the interesting companies you're seeing from a data perspective.
Sure. Yeah. Well, so there's several themes that I've been looking at that I mentioned, like future work, future transportation, etc. And I think now, big data and AI is there's such a broad term that they actually span across any area and sector that we look at. But I could be more specific in terms of, let's just say, future transportation. I know we talked a little bit about that, but we're investors in a company called PCAP, for example, which is a LATAM-based company based out of Colombia. And when the pandemic hit, they were a ride-sharing platform, but when the pandemic hit, they obviously could not do any ride sharing. So they actually pivoted to a more logistic-based company, and they capitalized on the growth of e-commerce. Everyone was buying stuff and had it delivered to their homes, much like you saw in the U.S. and throughout the world. And a lot of that data that they were able to collect, they were able to further refine their algorithms, make it more efficient, et cetera, and now they've become the fastest growing logistics platform down in Latin America. And it was just based on this pandemic on a whim. So I think these opportunities are emerging, and there's new pieces of information that are being collected or being generated from people working at home, not going out, et cetera. So these are some of the themes that I've been looking at.
Yeah. And David, you've spoken specifically about food tech. I'm going to start bringing in some questions from panels, both food tech and health tech being an area that you've been focused on through the pandemic.
Yeah, I mean, since the beginning of the crisis, I think there are, a couple of sectors, including food tech, agri tech, and health tech being pushed at the forefront of the scene, given the need and how close it is to our society and our economy. And basically, the thesis that we have here is that if we look at how in the food industry the trend has evolved over the past 10 years, for instance, there has been a massive push from the consumer end to get more transparency into what they're buying, but also the next leg was to ensure that once you get that transparency, this becomes the standard, and then you're asking for quality. And that's where we saw a massive shift on that front with regards to supply chain, resiliency, transparency, but also sovereignty here. So the first element is typically speaking, from upstream to downstream in the food industry, you start with the producer, you start with the farmers, and then you start to move across the value chain up to the food retailers that has the bargaining power, that has the weight in negotiating, giving the term, in the very fragmented market, which is related to the farming or the food producers. But today, when there's a massive push from consumer to get more transparency, but also certainty that what they're buying is actually what has been produced, the food retailers at the top of the value chain has to get access to the data that can then translate into what the consumer needs. And suddenly, the weight and the power and the balance of power start to shift towards the farmers and the producers, because they are, generally speaking, at the genesis, at the beginning of that process. But if you're asking for more sustainable practices, more ethical practices, you can't expect, the producers and the farmers, to squeeze their margin even further, because they're not living on super high wages. So to get the balance on that front, which is number one, for the food retailers to identify across the value chain who are the intermediaries, which ones are really needed, and which ones are not, so that extra margin that you are making can be used and reinjected to incentivize, the producers and the farmers.
I'm going to open up, David. I'm going to open up to some
make that model a bit more synced, by.
David, I'm going to open up some questions to all, and I'll do a few, and if we can answer quickly, just because I don't think we have a lot more time. But I am hearing, so one question I thought was very interesting is, what are your perspective on SPACs, special purpose access vehicles? Stacy, I don't know if you have a perspective on that. So I think that's one question I'm going to raise. The other is just the pandemic impact in valuation and check sizes, whether you've seen that come through. And then I'll look for a few more. So Stacy and Linus, I don't know if you want to pick up on either of those.
I can go ahead, Stacy, and I can follow up.
So SPACs are a very hot item right now. And actually, I just had, before this presentation, I just came off of an internal call where we're talking about all the SPAC deals that are in the pipe right now. You know, I don't really do much in terms of SPACs because it's almost like a modified version vehicle for an IPO. You know, have to get more information about it. But I just know that, you know, everyone's really interested in SPACs right now, and there's a lot of potential SPAC deals coming down the pipe, just in general in the US.
Yeah, it's so hot right now, especially here in the Bay Area. Everybody I know is doing a SPAC right now. And I mean, if you think about the history of it, right, or the history of just IPOs in general, back when when VCs invested in a company back in the 2000s, the goal for liquidity was always to IPO. But when the dot-com bubble burst, the government clamped down on IPOs. They passed several legislative laws like Sarbanes-Oxley and et cetera, to make it very difficult to actually IPO and made the legal process very onerous. So a lot of companies just started staying private for longer. And there were a lot of legal changes that made it made it easier for companies to stay private longer. So when the SPACs came out, it was pretty interesting. Like a year or two ago, SPACs always existed, but they were normally done by people that were a little bit less well known, maybe a little bit more predatory. They had a very bad reputation. And when more institutional investors or more famous entrepreneurs started doing SPACs, people started jumping on the bandwagon, and other people got into it. And now they're becoming more of a legitimized form of getting liquidity for companies. So from a VC perspective, I love them. I think they're great. We have a lot of companies that are exploring SPACs right now, considering the pros and cons. It's still not easy to do one. The company needs to fit a certain profile. There's a lot of considerations that go into it, but overall, anything that provides more liquidity to a VC, more options for liquidity to a VC is great. So I like it just from a personal perspective. But stepping back on a macro perspective, I always think that is great. It's great for companies to IPO because, just if you think about it at high level, the original, like the way the system was set up was an IPO was not really like the exit for a company. Like you see now with Uber going public after like 10 years of being private, it was really the beginning of the companies, right? Like that's where the public had access to invest in these game-changing companies. And the public has been largely shut out of that market for maybe 10 to 15 years. And now they might have better access to investing in some of these companies that are emerging. And I think that's generally a good thing. Obviously, you have the downside of there are going to be a lot of bad companies out there that the public will they may get swindled, or it might not be a good investment. So there needs to be protections. I mean, this is constantly evolving, but in general, I always think it's a good thing. So I'm pretty excited to see how these things go, and what eventually evolves.
Yeah, and it's interesting from the slides. You know, there's more than 630 highly valued private companies who are all seeking for an exit at some point, and the fact that it's coming up is going to be great for a lot of those companies. And I guess just on funding through the pandemic, you know, in looking at, I can answer this on the valuation and check sizes. When we've done various analysis, we've actually seen check sizes go up through the pandemic, not necessarily come down. And what that tells me is that there are, you know, companies often come to us and say, we didn't have to raise, we decided, which is a bit of a humble brag, we decided raise because we could, and we're growing, and we've seen more growth through this period. And so and often when you're an investor, you're not looking for a weaker company, you're looking for stronger companies. And so valuations by and large, from our experience, have actually held up and gotten stronger.
Well, I will add a little color to that, because I think from my perspective, that is true. Valuations have gone up. There has been a lot of capital in the system, which the data shows. But I think there's a story behind that data, which I can elaborate on. from what I've seen. So obviously there's a lot of capital out there right now. Interest rates are all-time lows. So institutional investors, people who have to invest in as a living, they can't put in fixed incomes like bonds or traditional fixed income assets. They put it into the stock market, and they also put in private equity, et cetera, more riskier asset classes. And so and interest rates have been low even before the pandemic, by the way. So there's a lot of capital, there's a lot of cash that's sitting on the sidelines, and people hungry to invest. But the types of investment they're making is very interesting. And I've seen it throughout all my companies. So very early stage companies where it's just a team and maybe an idea, and they have to spend 1 or 2 years building up the technology to prove that they have product market fit and can go to market. Those I've seen get a lot of funding. So very just 2 people and a dog type companies and a PowerPoint. Those are the companies that get funding. The other companies that I see get a lot of funding are the ones that have proven product market fit, have been able to sustain through the pandemic. Those companies, those valuations are going through the roof because they're just less risky and they're operating during a pandemic. The companies that I see that are getting really screwed or really hard to actually get to raise money or get high valuations are the ones in the middle, where you have your technology, you're ready to go to the market. You might not have product market fit, or you might have some inklings of product market fit, but it hasn't been proven. Those companies in my portfolio are struggling to raise right now because, one, I think the investors are just like, why do we have to invest in a company where the market can change next month? Maybe there's a vaccine that comes out, maybe there isn't a vaccine that comes out. There's so much uncertainty in a go-to-market strategy for these type of companies that those investors are not, they're not pulling the trigger on a lot of these deals. So the data is there that a lot of capital is going in, but is very skewed. It's really interesting how it's working right now.
Yeah. So I think we're going to have to draw to a close. Juan, thank you, and New York Startup.